there's statistics that show the most successful entrepreneurs share a couple characteristics. The first is resilience, and the second is grit. And so there's no substitute for those things. Resilience means look, it doesn't matter. Dust yourself off, get up, figure it out. And look for the opportunities. And so there's going to be massive opportunities coming out of this. And I personally don't see a big real estate crash coming from this virus. As I said, I've done economic analysis. I ran a hedge fund for many years and published an economic newsletter for many years. And this looks very different than 2008.
Welcome to the Accelerated Investor Podcast with Josh Cantwell. If you love entrepreneurship and investing in real estate, then you are in the right place. Josh is the CEO of Freeland Ventures Real Estate Private Equity and has personally invested in well over 500 properties all across the country. He's also made hundreds of private lender loans and owns over 1,000 units of apartments. Josh is an expert at raising private money for deals, and he prides himself on never having had a boss in his entire adult life. Josh and his team also mentor investors and entrepreneurs from all over the world. He doesn't dream about doing deals. He actually does them, and so do his listeners and students. Now sit back, listen, learn, and accelerate your business, your life, and your investing with the Accelerated Investor Podcast.
So, hey, welcome back to Accelerated Investor. Thank you so much for all of you. I know a lot of you guys are tied up in your homes. You're social distancing. You're spending time with your spouses and your kids at home, and the engagement on our podcast is skyrocketing. People listening to this, whether they're in their cars, but mostly at home, whether you're working out in your home, going for walks. Just want to tell you that we're thinking about you. We're thinking about all of your safety, of course, but for sure, your pursuit of freedom as an entrepreneur, a real estate entrepreneur, a business entrepreneur. And we're really happy to bring these podcasts and this information to you in this crazy time. So thanks for sharing this on social media. Thanks for sharing this with all of your members and all of your comments, questions, and reviews that you've been sending in. Today I have a special guest. His name is Bob Fraser. He is the founder of an organization called Aspen Funds. They invest in mortgage notes, both performing and non-performing, high yield performing and non-performing mortgage notes. He's been an investor for a long time. He invested through the crash of the dot-com crash of 2001. His partner invested through the crash of 2008. Of course, we're going to talk about those experiences and how they, how it helps him create perspective around what's going on with this natural disaster of 2020. They have over 2,000 mortgage notes in their portfolio, and we're going to talk about different ways to create cash flow, alternate ways to invest, especially investing in debt, and how to run a business and how to really kind of fly the plane in uncertain economic times. So, Bob, thanks so much for joining us on Accelerated Investor. How are you?
Fun to be here with you, Josh.
Fantastic. So, Bob, what I'd love to start my podcast with, my guest interviews with, is to talk a little bit about what's going on right now. I think our audience always wants to know, not to maybe start with your background from maybe 10 or 20 or 30 years ago, but let's talk about what's going on today. So tell us a little bit about your kind of money-making strategy in your businesses today. What do you do on a day-to-day basis in the business that you run? And of course, tell us a little bit about how your business has been impacted by this virus that we're fighting now.
Sure. Well, we're basically super busy buying notes, mortgage notes, and raising money from investors to do the same. So, we buy two kinds of notes. We buy non-performing notes, and then we repair them, and we also buy performing notes and collect cash flows and pay the cash flows. So we have 5 different funds. And so it's good times and bad times, right? And I love listening to what you guys are doing, because you're very opportunistic as well. You're not just looking for, hey, hunker down, but where's the opportunity? So we're doing exactly the same thing, and we're seeing prices softening, which we love. We love that opportunity, and so
That's great.
very busy buying, very busy building those relationships. We find investors are a little more, asking more questions.
Sure.
And a little slower to pull the trigger. Everybody, all the sphincters tighten when things like this happen.
Right.
And but that's all right.
So, Bob, tell us a little bit about how you guys acquire notes. Are you guys an originator who originates private money and hard money loans? Is it residential or commercial? Or are you finding now that maybe some other private money lenders or hard money lenders are, maybe feeling some of that liquidity problem and they're looking to sell portfolios? Tell us a little bit about it, for your own fund, and obviously for our investors and our listeners, how would they get into the note business of acquiring and finding notes to buy?
Yeah, we buy notes, and we generally we don't deal in very many hard money loans. Almost all of our notes are bank originated.
Okay.
So we buy loans that were one time defaulted. They're called troubled debt restructures, typically modified loans. They're sold at a deep discount to the UPB, and those are what we buy cash flowing, and we generally buy direct from the financial institutions or brokers, note brokers, or hedge funds who buy these and that kind of thing. So we're very busy. Generally, they're bought in pools, larger pools, but there are some also just third-party websites where these things are available.
Fantastic. So obviously this whole business of this virus is creating all this forbearance, and a lot of these notes are going to go into forbearance plans. I just recorded a podcast with a friend of mine who's the VP of market economics at auction.com, and we were talking about the spike in forbearances that are happening, which is going to create more non-performing loans. Banks are going to need liquidity to sell off some of their performing paper to create liquidity to just stay within their lending guidelines. And so how do you anticipate that this health scare, this virus business, is going to impact your business? Are you guys going to see a lot more opportunity and people needing to sell their portfolios?
Yeah, definitely. We're already seeing it, and a lot of when these money crisis happens, the money kind of disappears, and so the liquidity disappears from the markets, and that affects all investment sectors. We're going to see an increase in the defaulted notes, and there's always a crisis, and there's always these things happening. And what happens with banks is once a note goes into what's called non-accrual status, meaning that they don't expect to receive any more payments on this note, they basically have to write it down. And for second mortgages, for example, in most cases, have to write it down to zero. So it literally becomes a zero on their books. At that point, they can keep it around, but at some point you just got to clean out, take out the trash. And so even if those loans are restructured and they end up performing, they're still considered trash. So generally, it doesn't create a lot of opportunity, down the road. It doesn't happen fast. It's a 6 months to a year delay after the fact that those things really start hitting the market. But then there's a lot of, right now we're buying portfolios of funds that are kind of, exiting the business, and because they have liquidity concerns, they're selling off their note portfolios, which may be unrelated. You have a margin call in your stock account, and you need to sell off something else. So that's the kind of thing we're seeing right now.
Yeah. So for those folks who are looking at investing in notes, why? And we talked about this getting ready for this podcast, but the comparison between maybe investing equity in rental properties versus debt on a piece of real estate. Help our audience understand what's the benefits of each. You've done both. You've seen other investors do both, and you really feel strongly you like being on the debt side of things. So help our audience understand where's the play to buy notes or own debt versus owning an asset and owning equity, and why is your passion gone toward the debt side of things? Yeah,
definitely. Well, I lost everything in 2000. My partner lost everything in 2008, and he was a real estate guy. He was a real estate developer. Okay, took hard money loans, buying undeveloped land, and undeveloped land, the value dropped something like 70%, and where the housing market dropped 35%, undeveloped land dropped, or partially developed land dropped 75%.
Because getting financing to fund and develop land became almost impossible. That was the last tranche of financing that banks wanted to do coming out of the recession.
Right. So he borrowed money from hard money lenders, bought this stuff, was going to develop it. Everything evaporated. Ability to finance this new project. The economics didn't make sense anymore. And in spite of him having plenty of margin in this land, all of a sudden it all disappeared, and he ended up handing it back to guess to who? His hard money lender.
Right.
And the hard money lender basically ended up making money on that transaction at the end of the day. And that's when the lights went on. Some of us are not always, super smart up front, but we learn a lesson when it's presented to us on a 2x4. Right. So yeah, exactly. So the lights go on. Maybe debt makes sense. Let's get on the other side of the debt equation. And so we started this business 8 years ago to get on the debt equation and to really make something bulletproof. Having gone through 2 crashes, and we both lived through the S&L crisis in the 90s. So we've endured 3 crashes, and guess what? Here we are, number 4. And one of the lessons I've learned through this is that everybody is waiting for the last crash to happen again. It never happens.
Never
right?
happens.
There's
another one coming after this too.
The next crash is never like the last one. You can be sure of that. It's the one thing you're sure of.
Yeah.
And so we built a very bulletproof type model with notes by building high equity notes. We do very unique underwriting. For instance, we calculate how much money, if this property were to rent versus the principal and interest payment that's being paid to us, what's the ratio there? We only go where the rent is quite a bit higher than the principal and interest, which means this property is a super good value.
So you're looking at basically debt service coverage ratio, right? Is that what you call it?
Coverage ratio, but no, to rents.
Okay.
So we're the lender. We don't own the property. We want to know if someone were to buy this property and rent it and pay us our debt, how much are they going to make money? And if the answer is yes, well, then it's cheaper to own than to rent. And as long as it's cheaper to own than the rent, we know the price of this property is a good price. So we basically bulletproofed our entire portfolio over the last 2 years as we saw the prices going up to move where the rents exceed the principal interest payments by significant margin. We moved to bread and butter areas in the Midwest. And
so I'm curious, Bob, what's the margin? Are you looking for 25, 30% margin over principal and interest? What's the number?
Yeah, it can double in some cases. So, but yeah, you certainly want to see it higher, and so we've aggressively moved our portfolio into these kind of things. The other things we looked at is we buy owner occupied loans. Okay. You follow me? Versus hard money. So if you're a hard money developer and that you get upside down, right? You go negative equity on that. What are you going to do with that? Well, you're going to hand the keys back to your lender.
Right. Sure.
On the other hand, if this is your home and your kids are going to school and your wife is living there and your property goes underwater, what are you going to do?
Yeah, you're going to fight to keep it.
You're not going to do anything. Yeah. And it's your castle. So we buy, probably 95% owner occupied. So again, we've built a bulletproof kind of, and bulletproof's a big word, but we've bulletproofed our system, and all intentionally as we, with our scars, we wanted to make sure that whatever came next, we were going to be able to take care of our investors.
That's fantastic. Are you ready to automate and explode your real estate investing? We're searching for extremely motivated individuals who are sick and tired of wasting time and want to finally see real results from their real estate investing business. We're searching for investors looking to get to the next level and become a bigger, better version of themselves while being a more successful real estate investing entrepreneur. Apply for mentoring and coaching at joshcantwellcoaching.com/podcast. That's joshcantwellcoaching.com/podcast. For people who are interested in this type of investing, passively investing, you have funds. We have 3 funds that we run. So where can people go to learn more? You have a website, I believe it's aspenfunds.com if they want to check that out. Is that right?
No, it's aspenfunds.us.
.us, perfect. And what they would be investing in would be a pool of these performing, or depending on the fund, non-performing that you're going to get worked out. These notes that you're buying basically at a discount, and when you factor in, okay, there's a certain yield on that note based off of the unpaid principal balance. You're buying that note at some sort of a discount, which jacks up the yield, right? So people need to understand that's where the yield comes from, because people might be thinking, well, a performing residential owner-occupied loan might only have a 5% interest rate. So how do I make money on that? Well, the difference is that Bob's company acquires that portfolio at a discount, but they're still getting the 5% yield off the UP, unpaid principal balance, but their all-in number is some fraction, some wholesale price beneath that. So the yield goes up significantly. That's where Bob's talking about.
You got it exactly. And what's more is, because we buy at a discount, when that home is sold or refinanced, we recover that discount and it ends up being cap gains. And so people think in note investing there's no cap gains. Well, we have a lot of cap gains.
There you go. Instead of just instant income.
I'll tell you another secret, but then I'll have to kill you.
Well, tell me. You have to come find me in my basement home office.
Buy a lot of seconds, and we prefer to buy seconds. They are better financially than firsts. And
how so?
Yeah, well, so if you have a $300,000 property, $100,000 first, and $100,000 second, okay. Mm-hmm. Which one would you rather own? Well, I'll take the second all day long. Sure. Because the first, you're not going to get much of a discount. Maybe you get a 20% discount, 10% discount max. The second, I can get a 30, 40, 50% discount on that. So my yields go through the moon. And let's say in a crash scenario, am I really at risk? Not really.
Not really. You still got 30, 35% equity.
And then, so let's say I do get a 50% discount. So I paid $50,000 for this $100,000 note. Well, when this guy refinances or sells that home, guess what? I make 100% profit. I double my money. So not only do I get double my yield, I double my money. And these things are sold at crazy discounts. So I'll buy seconds all day long. Seconds are magic. And I love that people hate seconds. I love when I tell people, hey, I buy second mortgages. They're like, stay away. I love that, because
so Bob, help me understand the
super inefficient market.
Yeah, so help me understand the inefficiency, because if they're the lender that made the second, but they can still see the same equity that you see, but why would they want to get out of that mortgage?
It's a second. I'm telling you, that's not the way the world works. You're right. No one's really doing the true risk and modeling of this. We're deep financial nerds, and we do a real risk workup of this. We basically model our underwriting model. We look at every potential outcome for this note as a scenario. We do a probabilistic analysis of how likely is that scenario. And then we do a present value cash flow analysis of all the cash flows created from that scenario. And that becomes a cap of the price we pay for a note. So we're nerds. And we do things that the banks don't do, because they're honestly, most of the people are just box checkers, right? It's like, check the box, do the systems. We've done the homework to figure out the models that actually make financial sense.
That's fantastic. So you've learned your lesson from 01. You partner learned a lesson from 08. What are some of the things that you think you'd like to pass along to our audience with this health scare? What have you learned just as now a seasoned entrepreneur? You've been through some of those scares, gotten wiped out and rebuilt your businesses multiple times. Some people might be thinking right now, like, I'm going to get wiped out. I don't know what's going to happen. But you've already proven, because you and your partner have come back and reinvested successfully, that it can be done. There's some crazy statistic that the most successful entrepreneurs sometimes get wiped out 2-3 times before they hit the jackpot. So what advice would you pass along to our audience to say, look, even if you do get wiped out through this health scare, you can rebuild. There are some principles, some things that you can do now and in the future to rebuild another successful business down the road. What are your thoughts on that?
Yeah, and that's a great point, Josh. And there's statistics that show the most successful entrepreneurs share a couple characteristics. The first is resilience, and the second is grit. And so there's no substitute for those things. Resilience means look, it doesn't matter. Dust yourself off, get up, figure it out. and look for the opportunities. And so there's going to be massive opportunities coming out of this. And I personally don't see a big real estate crash coming from this virus. As I said, I've done economic analysis. I ran a hedge fund for many years and published an economic newsletter for many years. And this looks very different than 2008. I think you guys are on the same page with me on that.
We are.
We're 80% of FICOs are over 700 recently. Back in the crash, only 50% were in 2008. So we're seeing underwriting is a very different standard. We're not seeing the same level of speculation, which drove up home prices in 2008. None of that. Plus, we're seeing the housing market. Single-family homes have been massively underbuilt relative to
a lot of demand.
Yeah, relative to there's the number of single-family starts is lower than any time in the last 20 years, and it has been. And if you look at relative to population, single-family starts relative to population is lower than it's been in any time in the last 60 years.
That's great. It's good news for us.
There hasn't been any new product built. Population continues to grow. So you're seeing massive demand, number one, and then you're seeing basically this is an external shock versus an internal shock. There's nothing fundamentally wrong with the economy. So most economists are predicting a V-shaped recovery, meaning big crash here. Q2, but a recovery. I think it may be a little bit longer. I think this virus is going to hang out for a year or so.
Right.
We may have multiple kind of quarantines, which hits cash flows. So what we're modeling is basically reduced cash flows. So as borrowers, struggle, a certain percentage of borrowers, and let's say not all borrowers, but let's say, a certain percentage. In the Great Crisis in 2008, do you know what the default rate was on first mortgages?
You have to remind me.
It was 5%.
Yeah.
So it's not as bad as people think. Now, maybe this will be worse. Maybe we'll hit more, but maybe it hits 10. But that hits cash flows. Mm-hmm. So I think cash flows are going to be impacted for a while. Now that creates opportunity for cash flow investors to buy at a discount, but I don't think ROIs are going to be significantly impacted, except if you're in commercial, in hospitality or retail type products.
Right.
Residential type products, I don't think they're going to be significantly impacted. So my advice would be look for opportunities, solidify your investor base. And really take a lot of time to make your investor base comfortable, and look for the opportunities, especially in the cash flow sectors.
Yeah, I agree with that. I've got a couple comments on that too, and I'd like to hear your feedback on a few things. I just did this other recording again with my friend Darren from auction.com, and we were doing an analysis comparison to some of the hurricanes that happened in New York, New Jersey, Hurricane Irma, Houston, and then obviously the stuff that happened in Florida, and the amount of banks that stepped up to do forbearance agreements. And there was a big spike in forbearance agreements in those submarkets, right? Now we're talking about really the whole United States being impacted by this virus versus those hurricanes impacting certain cities or certain areas. But what they found is that out of all of the forbearance agreements that were offered in those areas during those natural disasters, less than 1% ended up in a foreclosure short sale scenario. So what bankers are looking at now is to say, okay, we basically have a nationwide forbearance issue, not just in Houston or Florida or New York, New Jersey. So let's go into this massive forbearance plan, and let's get realistic that people are going to need some forbearance. But if we strategically work these out with people over the next 6 months, a year, 2 years, tack the payments onto the back, work with people, again, these people will be able to afford their mortgages, and there's not going to be as many foreclosures, right? Because we're talking about natural disaster versus systemic economic financial problem like 2008. So that was really good to hear that the bankers have already modeled out a couple times through these hurricanes that if they offer forbearance, and I think that's why the Fed and the government were so quick to offer forbearance right away and say, let's give people mortgage relief. Let's give people rent relief because we've seen some areas where this forbearance has worked out well. So I'm excited to see it. Now, regardless of that, there's going to be some people that just can't afford their mortgage. They're out too long. They have a cash flow problem like you discussed, and they just can't recover. But people are always going to need a place to live, right? So whether you're in apartments, residential, or the debt underneath those things, that's going to tend to work out pretty well in the long term. So I'm interested to hear, Bob, your take on liquidity and investors. So we recruit a lot of money from investors just like you have. What have you seen in real time? You said, again, like the amount of calls that you maybe need to have, the investors maybe not pulling the trigger as quickly, it takes more time to educate them on what's going on. But you probably have a lot more money flocking to your offers because of what happened to the stock market. So talk about those levers that you have to pull, maybe more investor inquiries, but longer education time frame.
Yeah, and this is where having an 8-year track record, makes a difference, right? So people tend to look at you a little different, and we can point to a lot of things. And we actually had some investors come to us that were on the fence. And after this virus and the stock market crash, because literally we just posted a record-breaking quarter last quarter.
Nice. Good
and
for you.
So it's kind of like you're flipping off the stock market here, and investors tend to pay attention. Exactly.
Right.
So I think results really matter. I think execution really matters, and I think investor communications really matters. We're and in our last communication, we didn't sugarcoat anything. We definitely are seeing some impact. We're cautiously optimistic, but our funds are doing so well in spite of that it didn't even matter. We still posted a record.
Nice.
But we're not sugarcoating it. I never want to surprise an investor ever, right? I always want to play my cards face up, right?
Yeah.
And it earns a lot of investor trust. So I would say super important. Don't sugarcoat. Don't make things better than they are. But track record matters. So you can last it out and find the opportunities. I think you'll find the investors. But generally, I've been through several of these crashes and been raising money through them both. Money runs scared as soon as these things happen, but right now, because of our track record, we got institutional investors wanting to give us, tens of millions in lines of credit and these kind of things, that we're talking to. So the smart money is not scared money a lot of times. So you can go after the smart money.
In my newest real estate investing book, The Flip System, you'll learn the proven secrets and strategies that I've used to be a successful real estate investor. You'll also hear the story of my journey from quitting my job to doing over 2,000 units of apartments. The Flip System is now available for a limited time, and you can grab your free copy at getflipsystem.com/podcast. You'll learn the same proven principles and secrets and investing strategies that I used to quit my job and pursue a life of financial freedom. In this book, I'm sharing exactly how I was able to personally close over 750 profitable real estate deals, make over 400 private lender loans, raise over $30 million, and acquire over 2,000 units of cash flowing apartments. Get my newest book now for free at getflipsystem.com/podcast. That's getflipsystem.com/podcast. I just, again, saw some additional statistics about the amount of money, institutional money, that was moved to cash. Just this last month or so was something like $325 billion. And so a lot of investors that had money, but it wasn't because necessarily like lack of yield in what they were doing. It was that they had to create liquidity because of,
Exactly.
again, residential investors who are freaking out, pulling their money out of institutions. So then institutions have to take some of their money and pull it out and move that to cash to create liquidity. And so there's, again, still opportunity. I mean, there was one of the hard money lenders, private money lenders that we originated for, literally stopped originating a month ago. Just had a call with them earlier today that they're starting to originate again, which is great. Now the product is, again, loan to values are lower, FICOs are higher. The amount of experience they want is more. So it's a more expensive product and tougher to get, which is exactly what we expected. We expect people to come out and say, we'll lend again, but the criteria is going to be higher. You look at what Chase has done at Bank of America, they've jacked their FICOs up to over 700 at a minimum. So that's going to let some of those people that did maybe marginal credit, marginal experience, not going to be able to get as much liquidity or as much money. And so what's going to happen now is the operators who have great investor relationships, continue to talk with their investors, can manage through this, can basically fly the plane while the plane is going down, fly the plane and do well. They're going to end up with even more money, more relationships on the back end of this.
Exactly right. And so we find these kind of crises, the external shocks, and to your point exactly about the hurricanes and those kind of things. Again, those were external shocks. It's very, very, I think there's a lot of lessons we can learn from those, as you've pointed out. And I would be expecting a depression if our government had not done what they did. So my hat's off to DC. We give them a bad time most of the time, right? Most of us hate what they do, but hats off. They did it, and as everybody's gonna have a problem with what they did, but I don't. I think it's awesome, and they saved us from a depression. And what's happened is they put money in people's pockets so they can pay their bills, they can go shopping, and even bumping up the unemployment, this kind of thing. But what we find is the weak players get pushed off. And so I'm driving around my neighborhood and seeing all these the retail spaces with lease signs out, but these were guys that were probably really on the edge,
right?
Anyhow, you know what I mean? The comic book shop that never quite made it, and the cigar shop that never quite made it, and all of a sudden, and it's the same in everything. The weak players get pushed off the cliff, and that's in one sense it's sad for them. I get that, and it's the same with the bars that were barely making it. Well, now they're going to have to get rid of the home, and that's not necessarily a bad thing. It's a fresh start. If they can pull some equity out of their property and go get a cheaper place, they can live in a closer to their means. Same with the retail guy who was struggling with a business that wasn't making it. Let him go start fresh. It's better to start fresh sometimes, and it also cleans out all the noise in the system for us who are investors looking for investors, or those looking for deals. It clears out the noise. So again, the weak players are kind of moved aside.
Right.
So that's to me what is happening, and that's an opportunity.
That's right. Bob, I'm curious. I got just maybe two questions left for you, and then we'll kind of round third and head for home. What's your favorite way to communicate with investors? Is it conference call? Is it webinar? Is it video? Is it in a writing, maybe in a memo? I'm always looking for ways to up, my game and way I communicate with investors. Investors are always asking for more information, whether it's more consistently, whether it's more transparency, all those kind of things. But what's your favorite sort of mechanism for communicating with them?
And I guess I'm kind of old school. We actually take the time to do a full workup of our portfolios, risk factors, all this, and we publish a newsletter.
Okay,
So I do a quarterly newsletter. It's typically 3 or 4 pages. My favorite person I follow is Warren Buffett, and with kind of his. Here's the State of the Union. I give the State of the Union. Here's what's working. Here's what isn't working. I also do full financial workup and send that out for those that care. I care, and I do things that I think I would want to see.
Sure.
And I don't get a lot of questions on that, and because I think people see our full disclosure. But I love the quarterly newsletters, and we also, if there's ever anything that is, I try to treat it like we're a public company. So anything material that happens, I will also send notices out as it happens. So that, and then we've been doing for the last few years, we do a annual shareholder meeting again. following Buffett's model, and this year we're doing that all virtual. So that'll be a first. In the past, we actually, because I want to see my investors. So I actually, we made a really nice spread for them and really took care of them, catered everything and really because I want to see them. I want to shake their hands. I want I want to know them. And so once a year we do a 1-day deal. This year it's all virtual. So
that's fantastic. Thanks for that feedback. Yeah, we love it. I mean, we do a lot of stuff via a webinar, PowerPoint presentation, which is essentially, very similar to a newsletter, just broken down in a different format, if you will. But I'd love to get on and do a webcam type of update where people can see me, look me in the eye, even though it's virtual, looking me in the eye. Just a way to see that I'm still there. I'm not hiding behind anything. Very similar to the way you guys are very transparent with your newsletters. So, Bob, last question. Then I definitely want you again to kind of plug your website so people can get more information about Aspen Funds and about you. But any kind of final thoughts or pieces of advice? You've obviously been through several different ups and downs, SNL. I think people always like to hear from people that have kind of been through the ringer, right, as an entrepreneur. So what have you learned over the past 20, 30 years? What are some kind of couple bullets for running a business, being a successful entrepreneur, that you can kind of pass along to our audience and say, look, these are some things that you've got to have. Doesn't matter if it's a crisis or not. Here's how to run a successful business. A couple characteristics that are must-haves that you've seen that you think you carry through this crisis for you.
Yeah, I think there's no shortcuts through this. Truthfully, this is when it matters how you treated people. Are your people going to stick with you? And are you a jerk? Do you treat people well? Are your investors going to stick with you? Well, again, it's the same thing. Do you treat your investors well? And so I think it really matters how you ran your business. And I think if this is a time to figure out if you're going to lose everything, well, then figure out how to do it right next time, and take care of your investors. And then I think it's grit and it's resilience. Don't be shaken. I've been there, man, where no one was returning the phone calls, and you wondered why you were waking up every morning. And if that's the situation you're in, trust me, it'll get better. And look for the opportunities, not just the problems. And and get a good community, right? Get around friends, get around people that are upbeat, that are can-do people, that are solution people versus problem people. And change your view, right? Change your atmosphere, change your environment to a positive, upbeat, entrepreneurial thinking culture.
Yeah, I love it, Bob. That's fantastic. One of the things I've seen too in this time is I see entrepreneurs who are running businesses, they get maybe a little bit fat and happy over the last 10 years. And now, they're thinning their business out. They're saying, okay, who's my absolutely critical people I've got to have? Let's get a little leaner. Let's get a little meaner. Let's run the business. Let's not take things for granted. Let's not keep too many people that we really don't need. And they're finding the ways to, keep their absolute best A players, creme de la creme people that can help them develop things on the back side of this and take their business off to the next level. Because I do think it's going to be a V-shaped or a U-shaped type of curve. There's going to be a lot of opportunity on the backside. A lot of things are going to be thinned out, a lot less competition. And the people who have access to capital, investor relationships are going to win.
That's right. We're not looking for how to reduce our costs right now. We're looking for how to take market share. And, so that's our, and I think this is the perfect time to do that.
Fantastic. Bob, so tell us again, where can we reach out if our audience wants to get more information about you or about Aspen Funds?
Aspen, like the tree, funds.us.
Fantastic. So we'll put that in the show notes. Guys, go check out aspenfunds.us for more information about their offerings and their funds and how you can invest passively with them. Bob, this is great visiting with you, getting to know you a little bit more. I appreciate you jumping on Accelerated Investor.
My pleasure. Great to be with you.
You've been listening to Josh Cantwell and the Accelerated Investor Podcast. Leave a comment on our iTunes channel and let us know what you want to learn next or who you'd like Josh to interview. While you're there, give us a 5-star rating and make sure to subscribe so you can be the first to hear new episodes. Follow Josh Cantwell and his companies, Strategic Real Estate Coach and Freeland Ventures, on all social media platforms now, and stay up to date on new training and investment opportunities. To start your journey toward the lifestyle you've always dreamed of, apply for coaching at joshcantwellcoaching.com.